Hello and welcome to On the Mark Financial Literacy with Mark Zinman. Good morning, Mark.
Good morning, Monica. How are you this morning?
So far, so good. How are you today?
I'm doing well.
Excited about
nice and relaxed.
Nice and relaxed for the weekend?
Yep. And I have co-host today. This is Reese. Now, I want to share with the audience that this is not tax deductible. Okay. And let me see here. Sorry about that. And Rosie. These are our guard dogs, and they like listening to my podcast. They're learning a lot about financial literacy. So, and if you hear them barking, you always have to put a face to the noise. Okay.
There you go.
All right.
Are you excited for today's episode?
I am. This is like a really passion topic for me, and one that I deal with all the time. So I'm excited for this episode.
So today's episode is what you need to consider when opening a new business. Mark, why don't you jump right in?
Well, you wake up in the morning and you're the best plumber, handyman, doctor, whatever your profession is, you're the best at it. And you decide that today is the day you want to start your own business and you're tired of working for somebody. So you wake up in the morning and that's how you feel. And the question is, well, what do you need to do? The first thing I tell everyone is that you are responsible for the accounting and the bookkeeping of your business. You don't have to do it yourself. You can delegate that to somebody like me, an accountant or a bookkeeper, but you're ultimately responsible for what's reported to the government, so you can't abdicate all your responsibility. So that is one of the most important things, and one of the biggest failure points of most businesses is that the skill that you bring to your business is not 100% of what you need to start a business. It's probably half of what you need, and the other half is keeping the records of the business and setting yourself up properly. And in order to set yourself up properly, you should have an accountant, and if and when necessary, an attorney and a business attorney to do that. The thing that you have to think about when you're starting a business is, and the most frequent question I get is, do I need to be an LLC or do I need to be a corporation? And the reason why people ask that question is that they are told by their friends or in the media that you get to deduct more, it's better to be a LLC or a corporation than it is to be just yourself. And I'm here to tell you that is 100% not true. You get the same deductions in a business no matter what form you are. And again, I'll go over the types. So if you are an unincorporated business, you're called a sole proprietor. Okay. If you form an LLC and you have one member, meaning you're just a sole owner, that's called a single member LLC. If you have two or more people, like you have a partner, that is a partnership. And then obviously there's a corporation. So what are the factors that you need to consider if you want to or think you need to be a corporation or an LLC? So let's take one more step back. An LLC stands for Limited Liability Corporation. Limited Liability Company. And then there's a corporation, like you can incorporate and be an S corp or a C corp. So they basically have the same liability. The nuance here is whether or not you want the word Inc. in your name, which would be an incorporation, or LLC. In some states, I know like Pennsylvania, where we broadcast out of, there is an advertising component, meaning that when you form a corporation, you have to pay to advertise in the newspaper, and that could add a significant amount of cost. Anybody who's taken out an ad in the paper knows, and an LLC does not, so it could be a cost-saving thing. But the real reason why you would need an LLC or a corporation is liability. Liability is the most important factor. And when we say liability, if you're an LLC or a corporation, unless you are grossly negligent, and that would mean like I did it on purpose, the risk that you have from an event like a lawsuit or something like that would be your money or your investment or your capital in your business. Well, if you're a sole proprietor, they basically can go after any assets. If you had an event that was, in excess of liability. And getting insurance is very, very important. You want to, if you're a contractor, you want to have contractors insurance. If you're a professional, you want to have malpractice insurance. But those items that I worry about are items that you can't do. So if you're in the food business, for example, you definitely need to have a liability company. Somebody could eat a peanut. Okay, I'm just picking an example. So you can and you can take your business and grow it. You can grow from being a sole proprietor to an LLC or a corporation without any tax consequences. So you don't have to be what you're ultimately going to be from day one. So again, think about whether or not you're going to be sued. If you work, let's talk about certain kinds of people who may be independent contractors. Like somebody who sells insurance. What's your liability? You're protected by your E&O from your carrier. You do real estate. You're working under a broker. There's no liability. So you can have this discussion with your professional, but the main key in deciding what to do when you start the business is if you have something, your product, whatever, has liability that you cannot insure for, then you want to be some type of a limited liability or a corporation. Okay? So I'm going to take the road that we are going to form an entity, and then what your choices are. So I already mentioned that you could be an LLC or a corporation, and in most states now, the LLCs really became predominant in the early 90s, and they became much more, they're probably the most popular form of an entity now because they have been adjudicated through the courts that the liability differences between a corporation and LLC are basically nothing. So early on, which was better? Well, the true and tried one was being a corporation. Now the LLC has had enough time to, understand that the liability to the owner would be the same. So LLC or corporation, up to you. And so if you form an LLC and do nothing but form an LLC, then you are, depending on whether you have one owner or more than one owner, you're a statutory sole proprietor. If you have one owner, called a single member LLC, or a partnership. And I said earlier that you get the same deductions no matter what you are. And how do I know that and can sort of prove to the audience? Because if you're a sole proprietor, all your income goes on a Schedule C, which is a tax form for reporting income and expenses for a business. If you're a single member LLC, you file the exact same form. So being an LLC doesn't necessarily change what you can deduct. And that's something that you should got to keep in mind. If you're a partnership, it's the same thing. It's a different form now, but you still get to deduct the same thing. If you form a corporation, then forming a corporation, there's two kinds of corporations, a C corporation and an S corporation. So when you form a corporation, you're automatically a C corporation. And if you hear like in the news, and it's probably big now because we're working on budgets, and you hear like, what's the corporate income tax rate? That's what a C corporation pays. So a C corporation is a separate taxpayer from the owner, and they would pay tax on their own income as well. And the owner would pay tax on the income they get, which could either be payroll or dividends. And we don't normally like C corporations for small businesses because there's a possibility of double taxation, which means you're going to pay tax at the corporate level. I think it's 21% now, and then you're going to pay tax on a dividend. And corporations pay the same type of dividends out as IBM or Ford or the kind of ones you get in your investments, that they're taxed exactly the same way. Those big, large companies are paying tax on the income, and then they distribute it to you, and you pay tax again. So since we're the hat of the owner and the hat of the employee, we don't want you to pay 25 or 30% tax on the money that you get, and another 15 or 20% when you take the extra money, when you take out your profits. So the next thing is called an S corporation. An S corporation is an election you make, a tax election you make. You can make it within 75 days of when you form an entity, or 75 days at the beginning of every year. So you can start out being a C and then be an S. You make that election, all the shareholders have to file. It's called a Form 2553, and you submit that to the Internal Revenue Service, and you're an S corporation. And what's the difference between an S corporation and a C corporation? The S corporation, all the income from that flows directly through to the shareholder. So you're only paying tax once. And when you take that profit out, it's not taxed a second time. Now, I've explained C and S. The reason why that was kind of important is that an LLC is a very flexible entity. So we already discussed if you had one member, you're a sole proprietor. If you had two members or more, you're a partnership, but you also could be a C corporation or an S corporation. So it's very flexible. And I would say that on my recommendations, unless there's other factors why you might want to be a corporation, 99% of our clients are forming LLCs now. When you form an LLC, you're without doing anything. I already said if you're one person, you're a single member LLC. If you're two or more, you're a partnership. But that, and no matter how many partners or they call them members in LLC, no matter how many members you have, you could be a C or an S corporation. And why would we have somebody be a sole proprietorship versus an S corporation, which is kind of our two choices if you have one person? The difference there is that on a Schedule C, which is the same form you file as a sole proprietor or a single member LLC, whatever the net income is, that is your salary. So, you go out and you make, sales of $100,000, you have $50,000 of expenses, you have $50,000 of income. That is statutory your earned income. You're going to pay federal, state, local, and more importantly, Medicare and Social Security on that income. In an S corporation, you take the same person, the owner, and you split them into two people. One person is the employee, and the other is the owner. So if you are providing services, like you're a plumber or a lawyer or whatever, you are required to get a fair wage for your work. That fair wage is payroll just like you have it, maybe a job you have right now, and that's subject to Social Security, Medicare, and all those taxes. Whatever's left over after that fair wage is a return of your capital and your investment and your risk, and that's considered a dividend, which is unearned income and is subject to federal and state tax, but it wouldn't be subject to Social Security and Medicare. So why would I recommend a single member LLC, a partnership versus say an S corporation? If you have payroll, there's a cost to doing payroll. So if you're not going to make more money, or you don't project to make more money in year one or whatever year you're in, that would exceed a reasonable salary for yourself, there's no reason to be an S corporation because the taxes are the same. If you earn enough and you hire people and whatever, then it may be worthwhile. But if you're the only employee, you're looking at least $100 a month for the cost of having payroll. And understand that the first employee is the most expensive. Most payroll companies, it's $6 or $7 a month for the next employee. And why is the first one $100? Because that triggers all the filings, the employer filings and so forth.
Okay, so once you've decided what type of entity you are creating, what is your next consideration?
Well, one of the big things to keep in mind, and this is more abstract and concrete, is that once you decide to form a business, no matter what type of entity it is, you're now not one person but two. You're Mark Zimman, the podcast host and father, and you're also own an accounting firm. Okay, and that's two people. So you have to silo off yourself, and that's part of having a good accountant. And that's where people make mistakes, is that they commingle business income and personal income. So even if you're forming a sole proprietorship, just open another checking account. And if you don't also, another thing, I'm going to take a step back. You can operate under a business name without being an entity. And how do you do that? Almost in every state, you can file something called a fictitious name registration, which is, in other words, it's called a DBA, doing business as. So I could be Mark Zimman doing business as on the mark. Okay, so I still can be a sole proprietor without having to form an entity if I want to call myself other than my name. So we talked about siloing. How do you silo? You open a separate checking account. You either dedicate one of your credit cards you have in your wallet, or you get a debit card along with that bank account, and it can be a personal account. You don't have to have a business account. Even if you are a business, a business account is just mainly a designation of the bank, and there may be more charges on a business account than an individual account. And if you're One of the benefits of not forming an entity is that you could then have a personal account, which has much less fees. But if you are an entity, you're going to have a business checking account because by statutory name, you're a business. So you will need what's called an EIN, which is an employer identification number. That can be applied for through the IRS. Again, this is something that you can have a professional do for you. The EIN is the Social Security number of the business, AKA. And when you open up that separate business account, everything that is a direct cost, if you're spending money for that business and you wouldn't have spent it without the business, that's a business expense, right? Kind of definition. I'm a plumber. I go to the supply house. I'm buying some plumbing from the work I'm doing for Monica. I wouldn't be there buying something if it wasn't for my Monica job. So that's business. And correspondingly, since 90% of work nowadays is used on credit cards or debit cards, as opposed to people standing in a store and writing checks, you're going to make the decision at the point of sale what it is and pull out the correct credit card. I'm going to pull out that credit card that's dedicated to my business versus that credit card that is a personal credit card. Okay, and you don't have, and that's another fallacy. It doesn't have to be a business credit card to be a business expense. It is form over substance. It's substance over form, Meaning that if it was a business expense, regardless of whose name the expense was in, it's still a business expense. And the reason I say this is when you go out and get a corporate card, the guarantor for every corporate card is an individual. So there's no different liability using a regular credit card or a business credit card. There's no credit cards out there unless they do it, a debit card like your account balance that isn't going to make you personally liable for the expenses that you charge.
And that's actually a good point. And I don't know if this is a topic that you want to cover today or on a separate episode, but sometimes a new business owner who perhaps is seeking financing, perhaps from a supplier and not necessarily from a financial institution, will be asked to personally guarantee the cost for that purchase order. Is that something that you that you want to speak to today, whether or not you guide your clients to agree to that personal guarantee or not when they're making a large purchase from a vendor?
I think you just identified a great show where we could talk about how to borrow money and what's involved in it. But I'll say briefly is that we may be getting far enough away, but maybe dad or grandpa who had and mom or grandma who had a business would go in and want a handshake, and they say, they borrow money, there'd be no personal guarantees. There is virtually no type of loan, especially a business loan, where the owners are not the guarantor of the business. Now, what sometimes happens, how do we define? I've had clients who are longtime clients who get upset with the bank saying, not because they're not going to pay the loan back, just because they think that they earned the respect to have a loan without having a guarantee. So if you're married, the benefit of an established business may be that your wife or your spouse, I keep saying wife, but your spouse won't have to be a guarantor on the loan, which means that only you are. Why is that important? Because if you default and you have to pay, joint assets are not a part of your assets. Meaning that if you have a joint account with your wife, you own your house, they really can't go after any of that if you are the only person on the signature. But yeah, that would be a great one because I think that gets confusing to people as well, what the process of getting a loan. So we can talk about that.
Okay.
In a future episode, I'm sorry. Yeah.
Okay.
Or either that, or we can just stay on here for 2 or 3 hours, and hopefully people have hopefully people listening have very long drives.
Okay, so we've established that you need to create an entity and you need to separate your business from your personal expenses. You've raised a very valuable point that if you are making a business expense and you inadvertently use your personal card, not to worry, that is still a business expense, and so we need to account for that. Is there any, and maybe you don't want to name specifics, or maybe you do, but do you recommend any type of bookkeeping tools that can be used to track those expenses, or mileage that might make it more efficient for business owners to keep those expenses separated?
You want me to try and solicit advertisers here? I got it. Okay.
Just generally speaking, do you recommend using software to make that a process?
So a couple of things. First of all, back to the point of siloing and using your credit card and whatever. Having a professional help you guide through who's done this for other businesses will be of a great help, because that's probably one of the more common questions I have. If I'm buying gas for my car, is that a business or personal expense? And that can all be discussed with your professional, and it's going to be based upon the use of that underlying. I have a home office. Do I write my mortgage off? We could talk about that as a separate topic, but the answer is that you need to talk to someone, because some of these things are not. Remember, I said if it's absolutely 100% business, I bought supplies to do a plumbing job for Monica, that's deductible. But if it's something that has other use, like your home internet, your car, your home office, then you have to have a conversation, because not 100% of it's deductible. So how you calculate that is something that, I could have a whole episode on. So, but as far as software is concerned, it's very important that you keep records. So at our office, we have a tech stack that we use, and we have like 7 or 8 trained bookkeepers, and we do outside work. We support clients' bookkeeping. We support, we do some of their bill paying and whatever as part of our ongoing accounting practice. But in order to do that, you have to pick a tech stack. So our tech stack happens to be QuickBooks Online, but there's FreshBooks, there's Xero, there's a million out there that you could use. And again, I think that would be sort of a discussion to have with your advisor, because maybe they have a preference, and that preference isn't always because one's better than another, but just because of the fact that it's hard for a professional to be trained on 7 or 8 different kinds of accounting software and be an expert at all.
All right. So we have an entity. We are making financial transactions. We are hopefully generating some revenue, and so now we have something to protect. Do you want to speak a little bit about insurance?
Yes, insurance. So clients. I recommend the clients that use brokers and not sole captured. Like Allstate, Nationwide, they do all their insurance, while broker would be able to go out and be listed for maybe 8 or 10 or more insurance companies. And based upon the type of coverage you need, and what are the common type of coverage? Liability, okay, or malpractice in the case of a professional. Maybe insurance on your assets, like your tools or your equipment. If you have employees, you need employment practice insurance. That's what they used to call sexual harassment, and Monica's has an HR background. You know that's not it anymore. It's just that's just the norm. And you want to have cyber insurance to protect people's. You hear about all these breaches. Even though there's these breaches, there's an insurance company behind almost every one of them that's helping them manage and ransomware or whatever you hear. I don't think I've had any client have that problem, but then it's a kind of problem that if you have and you don't have the insurance, it could be very costly. But the bottom line is that every type of insurance that you need may not be the cheapest or the best coverage for one company, and that's why you need a broker, because they could shop your workers' comp for one, they could shop your general liability for another, so forth and so on. The second thing to keep in mind here is that people shop on price. You should shop on price, but you have to shop on price and coverage. So a lot of times people say, well, I liked in a policy for my liability, and the guy says, okay, it's $700, and meanwhile you maybe are woefully underinsured because you picked the price. These are competitive markets. Sometimes one insurance company might be more favorable for your state than another one, but it's not that materially different, and it's worth a couple extra bucks for the ability to sleep at night and have the proper coverage. And
also your broker. I mean, we don't want to ever underestimate the power of a broker. If you should ever have a claim, the broker's ability to represent your needs in front of the carrier can make or break.
I think what the audience is getting besides that is that there seems to be more than one advisor you need. You need an insurance person we already identified. You need an accountant. You might need a lawyer. You might need if you're going to have health insurance, you're going to need a health insurance broker to help discuss coverage with you. There's a wide range, and that's why having somebody like an accountant on your team will help you think about the things that you're not thinking about. It's kind of interesting. I talk about this often with clients, and we even talk about it when we're training people. we have people come to our office and we bring them on day one and they have to learn how to get in the computer, how to do that, how to get into this software, how to log into this, all these different things. And it's overwhelming because there's so many things. But if you already have 3 things down and you add 1, it's not overwhelming. So I don't want you to be overwhelmed with all these things you have to do. You need, like I said earlier, you're ultimately responsible for your business. You can delegate and hire a professional to help you, but you need to understand, and we pride ourselves, I pride myself at making sure that my clients understand their choices before making one. Like my dad said, never sign anything until you read it. It goes for everything in business. Don't agree to something unless you understand.
And another topic I'm hopeful we have some time to just touch on briefly today, but might be deserving of a more in-depth conversation in the future would be, we do hear from a lot of small business owners that when they're ready to hire their first employee, they might only need them on a fractional basis to begin with, and then do they have a part-time employee? Could they consider them a contractor? Do you want to just ever so briefly touch on, there are regulations around working, whether you are working with a contractor or an employee, and this is nothing that we have to abide by those regulations, and it's not something, for example, that the employee or contractor can really dictate to the employer so much as we are following state and federal regulations around that issue.
So this comes up all the time, even with established business. It's like a daily thing. So this is what I tell clients. Everyone you hire or bring on, or everyone you pay for anything, is an employee unless they're not. So you have to run through sort of a checklist about whether they're an employer or not. So if I hired an HR professional, I'm just picking because you just mentioned HR, and they're a company and they work for somebody else, they work for many people, that's automatically not an employee, right?
Right.
Part-time is not a determination of employment. And the example I use all the time that makes it sound kind of ridiculous, but sort of brings it to light, is that, I have a part-time employee, he's not part-time and he works different hours, so he could be an independent contractor. And I say, okay, well, I have a friend who, he works some hours a week at Home Depot and some hours a week at Lowe's. I guess he could be an independent contractor. And everybody knows, well, that's silly. Well, it's silly in your example as well. Because what's the problem here of hiring somebody, a misclassified employee, meaning somebody you treat as a subcontractor who should be an employee? The biggest one is workers' comp. So if you're in any kind of a field that has some danger to it, other than an office, somebody gets injured at work, you have pretty much unlimited liability without having workers' comp. The second thing is that the government wants their taxes. They want their Social Security, they want their Medicare, states want unemployment. So if you don't put somebody on payroll who should be on payroll, they can come in and assess you those taxes regardless that you didn't pay them. So and it leads me to the 2 most common ways that misclassified employees are identified, in which case the employer's approached. One is, I got hurt at work and they want a workers' comp claim and there's no workers' comp. And the second one is you lay them off or fire them and they try to collect unemployment and there's no record of them for unemployment. So that's how people get caught, besides routine things. So my general advice is really everyone's an employee unless you can come up with a way that they're not. And again, your professional or your accounting professional should be able to help you with that and talk you through that decision and run through the facts.
So you've hired your first couple of employees, you're generating revenue, you might be at a position where you're starting to think about scaling. Perhaps you have multi-state commerce. Talk a little bit about how the services of your accountant, that the services that your accountant provide may change if you are working in multiple states, operating business in multiple.
So we have, it's going to be different for people who may be living in California, where it's a huge state, and depending on where you are, working in another state seems kind of like a long drive. We're here on the East Coast, for which states are almost suburbs of cities. Like we're in the Philadelphia area, so New Jersey, Delaware, Maryland, New York, West Virginia, District of Columbia. They're all common places, and within a couple hours drive of our locality. So basically, people, that's just a normal commute for a job. And if you work in other states, then you have a few things. And we could talk about this as another whole episode of multi-state accounting, multi-state taxes, multi-state sales tax. Just know that it exists. But basically, if you work in another state, you may need to be licensed there. That's one thing. But the second thing is that they're going to want a piece of your state income tax that you may owe. The most common allocation factor by most states is sales. So if you have $100,000 of sales and $20,000 in another state, then 20% of your income would be attributed to one state, 80 to another. And again, a professional can help you. But that gets to another one, and maybe a more simple one, is how do I know what I need to pay for taxes? If I'm not an employee, we talked about larger companies where you may already be, where you may form an S corporation and be on payroll and have taxes. But what happens to your sole proprietorship and you have no taxes? How do you account for taxes? You have to call your accountant every week and say, I'm taking money. How much money should I put away for taxes? I have a rule that I use with my clients. I call it the 40% rule. And what does that mean? That means that, so if you work for someone and let's say you made $1,000, you would get a check for less than $1,000, say $750, because the employer will withhold those taxes for you. Now you're the person who's taking money. How do you know what the taxes would have been? So what's the 40% rule? The 40% rule is that if you say want to take $500 from you want to take $500 from your business, you want to be able to write 40% of the first check. So in this case, it would be $200, right? You want to be able to write a second check for $200 to put away for taxes. So what am I explaining here? I'm saying to you that if you got a paycheck for $700, which is the $500, and the 40%, which is $200, that your net would be around $500. Is it actually $500? No, it's going to be a little different. But this is just a methodology. And what am I trying to accomplish? The biggest problem, so taxes are very emotional. Discussed that before. So what we don't want somebody to have to reach in their pocket to pay something that they thought, I took my $500 out and might have to get part of it back. Mm-hmm. So what we're attempting to do, and remember, we're keeping our business separate from our personal, is and that extra $200 should go into a savings account. Mm-hmm. Is how I recommend it. But when you owe taxes, regardless of what that is, I owe taxes on April 15th. My accountant says I should make quarterly estimates. Whatever frequency you have to pay your taxes in, we want that money to be in one of two places, either still sitting in the business and not distributed, or in a savings account. And why is that? Because we want the business owner and we recommend this very, very strongly to business owners. If you are a sole proprietor, a single member LLC, and you're paying people, or you have a job where you used to get paid, you need to pay yourself. That is very important. We've talked in other episodes about budgeting. Well, this is part of the budgeting. You should be getting a regular paycheck because you don't want to work your 40, 50, 60 hours, whatever it takes to get that business started, and not feel like you're earning anything out of it. So we want you to take that salary, but we don't want you to then take that salary, figure that in your home budget, and then all of a sudden some accountant or tax preparer is telling you got to come up with several $1,000s at the end of the year. If you don't take it out of the business, then you didn't count it as part of your budget. Mm-hmm. Does that make sense, Monica?
It does, and it's a great point. And if anybody is, a partner of an organization and they're getting a distribution, and let's say they get a check for $10,000, you want them to take that money and don't see it as a $10,000 distribution. See it as 60% of $10,000.
Right, and
put the difference between the two in a personal savings account, such that at the time that you have to pay your taxes, you don't feel like you're paying money that you did not expect, and you just pull it from that savings account.
Right, and it's the same dollars, but money is very emotional, and so we're trying to take the emotion out of this. And the other thing we're trying to take out is that I have used that formula for many years, and I have never found, it's never going to come out exactly, but, it's funny, people want, if a client comes in and I do their taxes and I say you have $1,000 refund, I am a hero, okay? Or it can be any amount. As long as it's a refund, I'm a hero. And if it's an amount owed, I'm a goat, okay? So one of my favorite lines to my clients when they're upset about having to pay taxes is, if there was a commission paid, guess how much more money you would owe? And there is no commission paid by the IRS. So, we're incentivized to do the best work we can for our client. And when you owe money, the reason why you owe money is you didn't pay enough in. Not because your taxes are too much, not because somebody didn't do a good job. It's just a comparison of what I owe versus what I paid. But in this situation, so we have people putting that 40% away. So on December 31st, there would be a balance, say, in this account. And then when the time comes to file their taxes, if it turns out that the amount that they owe in taxes is less than what was in that account at the end of December, they got a refund, and they're very happy. So we play this sort of game to try and make sure that mentally clients are prepared and they're not making an emotional decision. And at the other side of it is, and we could have a whole program on estimated tax payments, but in reality, if you make more money every year, you're going to owe more money. And so there needs to be a methodology of putting that away so that you aren't in a crisis where you have to reach your hand in your pocket. And this works very well for that. It's a way of helping. It's like teaching somebody to fish, right? Instead of, so we're basically telling you can do some of this tax planning on your own. At the end of the year, you might want a professional to help you narrow that number down and make sure you're okay. But on a day-to-day basis, that's the best way of doing it that I have had.
And if we have time for one more question, when someone is thinking about starting a new business, there are different ways in which that business may be funded. Let's assume, for the sake of this question of you, that the business will be bootstrapped. So we have an individual, they have a full-time job working for another employer. They've decided to start their own business. Sometimes the concern is when do I take that leap? What does my financial picture would have to look like in order for me to quit my job where I have gainful employment and devote all of my time to my new business?
Great question. And I have faced that many times over the years and with my clients. And I will share that I have had to talk most of my clients into doing it. Like they'll come to me with these parameters. Like, I'm not happy. I think I can do better on my own. I have my own client. I think if it's something you want to do, everyone should try. The younger you do it, the better. Obviously, you have a family, you have kids, you have mortgages. It makes it a little harder. So you'd have to have an idea that you're established or can hook on. A lot of times people who start businesses may subcontract or per diem for other people as a way of producing income. I actually thought your question was going to, when I was listening to it, was going to be, how do we talked about Bootstrap, how do I fund my startup? And that I should mention that we talked about siloing yourself off. And one of the most important things is if you have to fund or seed your business, that money should go from you to the business and then for the expense, not from you to the expense and then, back it into the business. Remember that silo part. And as far as taking money out, when we talked about it, until you take back or make enough profit to be able to take back what you put in, it's not subject to tax. So that 40% rule, you put $10,000 to start a business, the first $10,000 coming out is not taxed. So you wouldn't have to do the 40%. It's a loan. Mm-hmm. So a loan versus income. And I'm sorry.
It's a lot of financial analysis that a small business owner's accountant can perform, such as a break-even analysis, and there's a variety of different statistical methods that can be used to determine for each business owner, for their unique business and their unique financial position, what they can expect and to plan that timeline accordingly. Would you agree?
Well, I would say that I totally agree, but I would say that the most valuable thing that I bring is objectivity. Mm-hmm. So you say, okay, well, when did you decide to start that business? Well, you're going to be in your own head. Like, you're going to have your pros and cons. You might write them on the, on a column paper and still have your pros and cons and not be able to decide. And sometimes talking to someone who doesn't have, skin in the game and who you value their opinion can go through and go those choices with you. I will share that I don't believe that, and it's not because of anything I've done. It's because the decisions were obvious that anyone who I helped or assisted in starting a business has been successful enough that business continued and didn't go under. I mean, success is measured in different ways, but it was the right decision for that person at the right time. So, it's funny because people come to you and give you all the things and then have one negative, but basically what they're telling you is, I made my decision, I just can't pull the trigger.
Okay.
So,
well, I think we've covered a lot of topics today. We've introduced a lot of topics that we will be talking about in future episodes. Starting a new business is certainly a complex process, but yet it is one that a lot of people have already, taken that journey, and Mark and other accounting professionals can help you follow that path. So that your learning curve is short and not long. Learn from the experiences of others. So, not to worry, there is a formal framework that can be followed, multiple formal frameworks that can be followed. So in future episodes, I understand we're going to be talking about different aspects. This is just one of many in a series that we plan to discuss. And to that end, if you have any questions about starting a new business that we didn't cover today, we would love to cover those topics in one of those future episodes that I was mentioning. So please go to onthemark.cpa and submit your question there. We thank everyone for joining us today. Look forward to seeing you next Wednesday. And thank you, Mark, as always, for all the insight that you are sharing with us.
All content provided on this podcast is for informational purposes only. No representations are made as to the accuracy or completeness of information that is presented. On the Mark, its owners, collaborators, and guests will not be liable for any errors or omissions, nor for any losses, injuries, or damages from the use of this information.